Hey everybody, DayTraderRockStar here, and just want to say hi. This is kind of a follow-up video from yesterday's intensive webinar on trading futures, specifically the micro contract, the MES. We had a great webinar, had a great turnout. I sent out the video today to the members who signed up for the video and went over a lot of different things. A lot of things from the basics all the way to more advanced material. But the great thing about it is all concise. The methodology is sound. It's logical. I love how everything's set up in the business plan. Really defines what trades you want to take, when you want to take them off, and it's a business plan. It's a business plan of making money. Your job as a trader, just like if you were working at your own business, you have a business plan. How do you make money? For as a trader, for me, myself, I trade divergences and I teach divergences. And there's all different aspects of that, and I try to teach some of the concepts of that, and you know, we have a great community. So I want to go over some things that I traded today all day, and we really focused on a lot of skill sets that we learned yesterday, went over yesterday. So I wanted to follow up today and just kind of talk about one thing that I think is super important, because today we really showed the market in a certain trend. And well, let's go into it. The important thing is, and this segment of this video, we're gonna scroll back. This is live right now, so this is the S&P live right now. We're down 9 points, and I haven't done any trades since the close. But I can point out spots where you should have traded tonight, and who knows, we might get a trade in tonight. It's about 10:16 in the evening, and we're gonna go back. And this is during the day, and this is my trades today. And again, if you're not familiar with what I do, I host a I host a show every morning on DayTradingRadio.com. That's DayTradingRadio.com. And basically, I share my screen, and we teach trading. We find the trades. We have a great community, great chat rooms. We're trading stocks, options, and futures. We have breaking news. It is a full, blown show. We have music. It is absolutely a fantastic thing. I love doing it. We're there probably about 7:30 in the morning. We trade all the way to 4, so there's not much break there. And it doesn't mean that you have to be there from 7:30 to 4, but just to let you know, that's and then again, overnight trades. If we are there on Tuesday nights, and last night we had the big webinar on Wednesday, so there's always overnight shows on Sunday. Sunday night we have an overnight show, so good stuff. But the concepts, are sound, and I want to go over, what I want to, stress tonight is taking these trades, and again, I'm not going to teach the trades right now. That was done, and that's done every single day. But for those who know my trading style and the way we trade, we trade divergences, buy and sell divergences, and there's other setups I like to trade. There's basically 3 setups that we trade. We trade the what I call the lane divergence, lane stochastics. I trade everything with the stochastics. So I feel comfortable saying that, I'm a master of different styles of trading on stochastics. I've been trading stochastics probably close. I started trading in '96. I started trading with stochastics probably right after the tech bubble. But really intensive training, teaching it since 2008 to 2010. And now we've taken it to a whole new level over the last few years. We built bots around it. We have all kinds of indicators, and it's a business plan. The business has grown into an awesome thing here. So there is a situation. Here's the situation. You have your setups, and this we're going to talk about today. I want to just bring this over. I'm not going to try to blow you away with a lot of different things, but I want to talk about one thing, is trading divergences in a downtrending market or an uptrending market. We're going to call it a trending market, all right? When we talk about trending market, something that's moving in a direction. It's not real choppy, not really sideways, but it's it's kind of trending market. Now I'm going to just put my whole thing. I'm in the process of adding a lesson to the webinar and to send that out, and I'm just writing it up, but I I just want to get it out there. This is the rules to keep you consistently profitable. I think this is super important. This is like the key ingredient. You just need a little of it, but it makes the whole meal, it makes everything work great. And it's super, super important. So this is kind of one of the most important things you should do. This is going to keep you profitable. It's going to keep you out of trouble. It's going to, if you're, if divergence trading on itself is probably gives you a 70 to 75% success rate, on the trades, adding these extra couple rules to it will add another 10% to your trades. So you're talking about a success rate of probably up in the 80%, 85% range. Now there's always going to be times when the market breaks down, and we have to accept that. That's part of trading. You have to. There's things that we cannot control. There's algorithms. There's programs. There's breaking news. Like even today, the market sold off when one of the Fed speakers came out. And once it happens and it kind of gets the market in a certain trend, you might be in a trade and it just takes you out. So there's always going to be that situation where you could get run over or something. There's never going to be a pure trade. But this is the closest thing I would say to the Holy Grail. I always say don't ever use that. There's no such thing. The market's too unpredictable. I also would consider the markets kind of like a casino. But, as an analogy, I always say, what game do you go to the casino? Well, the one that has the best odds. And, and I always use blackjack as a guide. If you go there with serious blackjack players, they have that little cheat sheet, and they tell you exactly when to bet, what you should do in certain hands. And this is what this is exactly what this is. It tells you what to do when you see certain things. Our stochastics are our hands. And when we're dealt a good hand, that's when we want to bet. All right, and the hand is defined. I already gave you the cheat sheet. It's all there. Now, what do we do when the dealer's on a hot streak and it's killing us? Well, what happens is the market's in a trend. Like today, the market was moving up nice, and then news came out. I don't have a volume chart on here, but the news came out, and all of a sudden, the market here sold off. So at 9:30. We're actually, let's take a look at the pre-market trade. I want to go through this with you. All right. This is what time we get in the morning. So I got in probably a little bit around 8:30. I actually was in early, but I didn't get in front of the computer at about 8:30. Right at 8:30, we had a textbook sell divergence. I mean, it was so perfect. Now, I did not take it. I was just sitting down in my chair. I noticed it. I called it out. For some reason, I didn't have my trades. I didn't have my platform up yet. I didn't have anything prepared. So I just kind of missed that divergence. I just kind of missed this too. I just kind of, there we go, fix that. But that was probably one of the best setups. And again, the divergence is when you have, this is kind of just a basic. But the divergence is when you have, and again, this is a sell side divergence, when you have a high and a high on the stochastics, a quick pullback, and you get a higher high, but the stochastics fail to rotate back to the original high of the first high. And basically we use that 80 line as our guide mark, our line in the sand. We'd like to see one to be above it, then the other one to be below it. All right, as long as the angle, and there's an angle to here. I always put, if there's you could put a degree on this and say this is, maybe a 15-degree angle. You want to get your stochastic angles above 10 degrees. And when I'll show you, that's more of a complex little, concept. And we don't talk about it as much, but it's about the steepness of the divergence. Sometimes you can move up here, and there's might be a high here and a lower high here, and it's still a divergence. But this line between the two is kind of more flat. It's up here. You can still have a divergence up here. The steeper this line, the better the divergence. And then again, this is on the 9-3, this is on the 14-3, this is on the 60-10. What's great about this setup is the 60-10 is now overbought. So that's your bigger trend. Usually when you get a kind of an uptrend, when the 60-10 gets overbought, that represents a 5-minute time frame, and that's usually a change of trend, and we have a major pivot there. And a pivot is just basically the stock or whatever you're trading going from one direction to another, and it leaves a pivot. It's a pivot area. And there's pivots, there's big pivots, there's huge, there's 1 minute, 5 minute, 60 minute, anything you look at. You could just say there's a pivot there. There's a pivot here from this downward trend to this uptrend. There's a nice little uptrend, there's a pivot here. So we always love the pivots. We trade a lot off of the pivots. So we get into, so the day starts off, everything's really good, and then we have coming into 9 o'clock. This is one of my favorite divergences. You have to be right in front of it. You see this little dip here, right here, this candle right here. I want to try to circle some of these so we could kind of, I don't want that. Let me see, what do I want on this? I'm looking for my circle. Oh, it's under here, right? X that out. So here, my eclipse. So this candle right there, that sneaks down and takes out the lows, but the stochastics were kind of just sideways there, and they didn't move down. When you see a fast, like you're moving down, and you're in a downward trend, and you think that maybe there's a pivot coming up. It usually pulls away from the 20-period moving average, and you have a first stage of a divergence. They move up here, and you're watching for that little spike down, but kind of a higher low on the stochastics on the 9-3. And that's what we got. And especially when we have a fast little candle like that. Dropped out, came back, and from that point on, it didn't really turn down here. And from that point on, it told us we're probably going to shift. And this trade would be taken right from here, right up to here. And now this is the concept that we're talking about today. We must, and again, if you're a beginner trader, this is going to keep you in the game. When you identify a divergence, identify the divergence, all you have to do is watch the show each day and trade alongside of us, because we're calling these out every day and taking these. I'll show that, but I can't push the button for you. I can't do that. All I can do is point them out for you. So you have a divergence and you have a move up. Now, how far do we know this is going? We don't really know how far this is going. We could gauge some momentum. We could feel the market out. What's our experience? Well, right now it's about 9:05. It's before the market opens. It's going to get very volatile at 9:30, as you can see here. But right now it's a little bit before. You have a divergence. The stochastics have turned back up, and you have the momentum. So you want to be long here. That's the buy side divergence. You want to be long. But how long do you want to be long for? So the rule is to keep you in the game is to take. And again, a lot goes into, let me try to bring up my my notebook here. We're going to take a look at the math here. Well, that's the screen. So take a look at the math. I would, when I trade during the show, I'm all over the place. I'm taking questions and answering, but I also want to trade the futures. I love trading the futures. So I usually take, between 1, 2, 3 contracts. I recommend highly to start off with about 3 contracts. To start off at 3 contracts. I mark them with, you got to be in them with real money to mark them and to feel, to really commit to it. So I want to always commit there and let the trade work out. So I'm trying to take those. And in some cases I take 1 contract. It's just so I'm in and we could prove that the technique is sound and stuff. But I always highly recommend that you start with about 3. 3 is the minimum. It's okay for me to do 1 because I'm not even paying attention to the trade. I'll take it. We'll try to take it, and I'll take it off right when it hits the target. And I'm very disciplined that way. Now, the reason I'm telling you this, that if this was any other day, I got 8 trades today, 8 successful trades. The average trade was for 1 point to 1.5 points. So about 4 to 6 ticks. And that's not a big profit zone. That's not a big profit, especially when the market's running 10 points in a few minutes times. But today was kind of a downward grind. So when you have that downward grind, you're not looking for those big moves. So this rule today that we're talking about, and again, I wanted to talk about, starting with three MESs. If we took one point per contract, and I had three. I actually had three on. So it actually, it would be 3 points, or 1 point per 3 contracts would be $15. So an average trade, if you had 3 contracts and you got that 1 point, would be $15. Doesn't sound like a lot, right? Multiply that by 8, and you're you're at $120 for the day, just trading a very small amount. Now 3 is extremely small in the contract size compared to, it's 30% of a or 0.3% of the ES. It's one MES is 1/10 of an ES contract. So an MES is 1/10 of the ES contract. So if this was an ES contract and you were just trading one, instead of 5 points, you'd be getting $50. You would be getting $50. All right. So we get an average of $50 per trade on an ES, just taking one contract. But the risk is there with it. If you had 3 contracts on, which I don't advise for newer traders, and again, I'm always trying to focus on the beginner trader to keep them in the game. Because in the beginning, you're gonna tend to go on all kinds of tangents. You're gonna try to do this yourself. This is a path that I've traveled for the last 25 years. I would not keep on stressing the same things over and over again unless I haven't gone through that and know it, and see hundreds and hundreds of traders come through the doors and see how they trade and understand their, and talk to thousands of traders throughout the year. You have to be disciplined. You have to have a method that keeps you locked in, and you have to treat your trading like a business plan. So that's why I always have things just kind of written out here, so you can really be organized and stuff, and you can look at what the potential is. So thinking what I did with 1 contract, multiply that by 3 on average if you want to start with 3. But I always say even start with 5. We're going to talk more about that in other videos, but that's just something I wanted to touch base with you. Let's go to what I was just working on something new here. Rules to keep it consistently profitable. It's super important. In a confirmed downtrend defined by one or more of the following: a trend that holds the 20 and 50 moving averages, EMAs, or the 60-10 stochastics are starting a new rotation phase going from oversold to overbought, or the opposite, going from overbought to oversold. Now I want to explain those two things. This is how I determine a trend. But normally you could look at a chart. We're going to look at this chart right now. Let me bring up the chart again. And we could see either the stock, like right back here, kind of holding the 20-period moving average, holding the 20-period moving, and then we break underneath it, and then we break underneath it. We kind of hold underneath it, and if we keep on going back and forth, that's kind of a choppy. We call that a choppy market, back and forth. But when we get into a trending market because of news or something, which we had today, we tend to hold that level. And if you could identify, and you go see what news came out. Now this is 9:30 at the open. All right, we'll go back here. The open to open up. And usually in the open, you're going to get a lot of divergences. So I kind of noticed there was a couple here. You had that fast little flush. Remember we talked about this? Stochastics are heading up. We get a little flush down here. Nothing really turned. I thought it was a divergence. I got in, and I got Ralph after a point. It was a real fast trade. I wasn't, it was 9:30. It was very volatile, and I didn't want to get chopped up. So I got in. I got a point fast. 2 points. It was $10. It was nothing. But again, that was a little bit more aggressive. We came down here, and then we started really starting to feel that divergence setting up. You had a low here, and then you had a low here, a higher low here with a higher low here. And then you came down with this candle here. And we were looking for this. And there's a concept we call running divergence. It happens a lot. It's a very strong divergence, but it's a tricky one because it puts in a series of, when we talk about putting a stop for a divergence, and we say, all right, that's starting to turn up here, let's put our stop in here. This came down underneath it. And then probably in most cases, if you took that divergence here, right here, which I didn't, but there was a reason you might have, wasn't the best, but you might have taken that. You might have said, oh, this is real low, this is much higher, I want to get in here. You probably would have made money. because you want to take it off at the 20 period moving average. Actually, there would have been nothing wrong with that trade. That would have actually been, but see how volatile it came back, and then it came back again. And once it came back again and took out the lows, I realized the stochastics didn't turn down there. And that's a very strong divergence right there. Right at that point, when we took out the lows, the stochastics, actually the next candle started to push back up, or it actually started pushing back up. So I took that trade, and we got into that. And that took off, all right? And yeah, I didn't get a lot on it, all right? I had 2 contracts. I took one off, and then I took another one off a little bit higher, and I should have had a better trailing stop. I mean, that was probably been the best trade of the day, because it went from 95 to 40, 45, it went about 50 points. 50 points. 200 ticks. I mean, that's a great trade. If you, go to the bathroom, come back, and next thing you know, 50 freaking points. That's a lot. So always got to work on keeping multiple contracts and trying to keep one on board if you feel strong about the divergence. Now, this was a real good divergence, because here we had a low. Let me see here. Here we go. We had this low here when the stochastic, last time the 60-10 were oversold, we marked that off, that low right here. It wasn't a low. It was a little low there. But I'm marking off the last time that 60-10 was down there. It was right here. And then the price went down, but the 60-10 was way above that low where it should have been underneath it. It should have been way down here, because we actually went lower to that. And I was looking at that. I said, oh, this is really going to be a good setup. And that's how you could tell that the rotation, and that's why you should always keep keep something on if you have a divergence on the 60-10. The 60-10 represents a 5-minute time frame, and when it goes, and you want to be able to take advantage of them. Those are money-making trades. This is a perfect setup. You have a divergence, plus you have a divergence on the 60. That's dual divergences, super signals, rock out with your stock out type of trade, makes your day. All right? So we actually caught that. That's all I want to do, is identify these trades for you guys, among other things. So then the market ran up here. Again, remember, I'm trading and doing the show, so I'm not constantly in and out, but I am doing it. I'll tell you the ones I missed, because they're not on the chart, but I could actually see some of these that I missed. And we go back, and the best thing to do is to review, because if you do miss one and you see why you missed it, or maybe you were in the bathroom or something, that's okay. But if I could show you a divergence, let me see what that's F2, right? I don't have to worry about it. If I show you a divergence, and I say, my rule, DayTraderRockStar's rule, is show me a divergence. I'll show you a stock that goes in the direction of the divergence. 9 times out of 10. And if there's other things setting up, like a channel, I could predict exactly where that stock is going to go. Or I say stock, but that future contract. In this case, you had a kind of a little channel here. And once you have a little channel, what we call a 1, 2, 3 channel, we have pivot, 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 and pivot. Once you have a channel and a divergence inside a channel, 9 times out of 10, that price is going to break out of the channel, meaning it's going to go up out of the channel. That this entry will be a pivot. It will be a pivot. So we did move back up. All right. Sorry to go back to this. I had to take a break there. So you had a nice divergence. You got the breakout. But when do you get out of these trades? Now, to be consistent and not be a gambler, I like to call smoking the hopium. That's hoping always that your trade's going to go higher. You don't worry about that. You know that you're in the best trade, a great situation here. And the one thing I will almost guarantee you is every time we get oversold on that 9-3, the market tends to reverse and come back a little, depending on how the bigger trend is. And the bigger trend is being mapped down here on the 60-10. So you start to see that 60-10 start to turn over. This ends up being, your sell signal for me. I highly recommend for beginner traders, if you have 3 contracts, take 2 off when you get above the 80 line, or you approach that 80 line. Now that's one area. If you get up there fast and you have a little profit, wherever it is, you take it off. Now usually you're going to see a nice pullback from there. You can always get back in. You also measure that out. I can measure that out easily if you should get back in or not. But the safe bet is most likely you are going to get a pullback. And just say you get a divergence and you're here and you're up here and you got 2-3 points and it starts pulling back on you. You're probably going to get shaken out or get frustrated and get shaken out, because lots of times these things come back when it's just overbought. It comes back halfway before heading back up. So it's always best to take it off into strength. And this works. This is for the opposite too. I'm not going to make 2 videos, but and I'll show you a short side one. There's plenty of shorts available. So your entry is on a divergence, and your exit always is when you breach or touch or approach the 80 line. All right. Some cases you might go higher, but if you're in an uptrending channel, that's when you're going to be keeping those things on. All right. There's a couple rules that you want to watch, and you just kind of get used to watching the markets. The market's in an uptrend, then you want to keep those on a little bit longer. If it's in a downtrend, in this case it was a little downtrend. We kind of had this 60 starting to roll over, so we kind of start to consider this kind of a downtrend. Then you want to take the positions off on your first rotation. If you're in an uptrend, you could hold on longer and probably ride that with the 60. Use your 60-10 as your gauge, or whatever and the next biggest time frame. Now you got a nice little move, and again it kind of pulled back and chops around, but that would have been a nice profitable trade, no doubt. That was a winner. The market continues. It's chopping around here. I'm not trying to overtrade. I am looking for one position. Now you might see the correlation, the relationship between the stochastics and the price, and every time we get overbought, we seem to pull back, and we get oversold. We kind of move up and pull back. And why don't we do that? Well, some people could, but the divergences are so good. They're just so perfect. Now here's the divergence here. Again, there's good divergences, and there's great divergences, and there's good divergences. I like to take great divergences, and I tend to find out the divergences that are great have a steep angle to them. Now I don't have there's not a degree marker on here. On my quote tracker there is. I don't know if I can put that on here, properties on a trend line. Can I put properties? Can I put a degree angle on there? I wonder. Lock. Visible. No, I can't really. Anyway, it's probably about 10 degrees. That's the divergence we're looking at. We have a low, we have a pop, stage 1. Stage 2, we like to see that divergence hold above that 20, but if it's above 10 degrees, then you gotta like it. And you have other things that are working for you too. We talk about the reversal candle. Here we have a nice reversal candle. It's a piercing pattern. And we're looking for 5 different candles: piercing, engulfing, bullish engulfing, piercing, hammers, and then of the opposite, dark cloud cover, the shooting star, whatever you want to call them. They all have names, but there's actually about 3 or 4 that we just pay attention to. This is a piercing pattern where it goes down and pushes back up more than 50% of the previous body. I like when there's a large candle or a large tail, that the skinny part of the candle. And the tail has to be at least twice as big as the body. But in this case, if it's a bullish, this is a bullish candle either way. It's not a hammer, it's a piercing pattern because it went up so high and closed so high. So the combination of that, the higher low, 200 period moving average, makes this probably a 2-star divergence, and you want to take those 2-star divergences. Also kind of gives us a downward channel line to work with right here. And we kind of have this little channel that's kind of playing out here. It's not much of one, but whenever we have a divergence, you have an underlying channel, you're going to break out of that. And you get up here, probably right around here on this candle right here, up against the 50 is probably where you will want to take that off. Now, yeah, you went a little bit further, but look what happened later on. That's the safe bet. That is the safe bet. The entry is easy. You're in there, probably in here 25, call it 25. And if you're out, 28, it's about a 3-point trade. I mean, probably if you were perfect on it, you probably got 5-6 points on it. But I'm not looking to be perfect. I'm looking to get an average 0.3 points per trade on 3 contracts. 1 point is a given. Remember, we're going to be taking 2 contracts off here. We're going to let 1 ride. So we might probably even get some more. Now start doing the math, Start doing the math. If at that point right here, we're looking at this as a divergence pretty much at 22. 22, 23. Easy. 22, 3, 23, we're in, and we're out here at 30. So I'm way off on I'm way off on counting this. I was just eyeballing it. That actually was a lot of points there. So I'm in. Again, 3 contracts, 2 are off. You get in 3, 2 come off on the first rotation above this line right there, which brings us right up to that 50 period moving average, which is great. That's 31. Again, 31, 21. That's a 10-point move. That's a 10-point move. Wow. 4 ticks. That's 40 ticks, basically, but we'll call 10 points. Wow. All right. That's $50 a contract. So it's 100. You take off $100 right there, and you have 1 contract left. And then you have it followed up with a trailing stop, and you get taken out somewhere around here. Market comes back down. We wait for the next setup. I don't care what the market. Now we had some news come out. Market started selling off, and you see how we're underneath the 20 period moving average here. This becomes important to realize. We're actually under the 50 here. We're having a hard time. We're starting to feel this. We're in the markets every day. We can kind of feel the tide. Here we have, and we can start to realize by looking at our set of indicators, we're going to have 4. I only have 3 up here now, but we're missing the 44 on this. And the 44 is a special one. And I almost put it on here, and I said, you know what? There's so much information to go over tonight. I'm not going to go over the 44 again. Once you start to, actually you had a tiny divergence here. Now again, the divergence only happens when you have a lower in the price and a higher in the stochastics. It's the only way you can really do that. And we kind of make sure we have a good quality divergence by having a low and a higher low and a bigger angle. But for whatever reason, I always say, if you get in and it's divergence, look what happens when you get your rotation here. You got your rotation, it goes up about here, you're probably getting out right here. Right here, you're getting out. And you might not say, oh, I only got a point or 2 I want to hold on to. I want to get more out of this. This is, no. First of all, we're in a downward channel. Anytime you run up against the 20 period moving average, you should be taking your profits, your first profits, either way. It doesn't matter. The odds are if you're trading under the 20 and you move back up, this is easy to read. You're underneath 20 down here on the 60. And I know this is way over a lot of people's heads, and I'm just rattling off. It's under the 60. What's the 60? Well, the 60, once that gets embedded, and over my years and years of trading, I developed a great indicator for a bull-bear flag. Now, what is a bull flag or a bear flag? A flag is what we call a continuation pattern. There's different patterns: head and shoulders, inverted head and shoulders, bull flag, bear flag, pennant formation, rising wedge. These are different things that you might have heard in trading. Well, the flag is one of the more important ones. It's a great little, it's called a continuation pattern, meaning it happens when there's a larger trend and you flag out into it. Bull flags and bear flags, very important to know. Probably one of the So I've developed a technique to identify if it's a real flag or not, and we use our stochastics for it. And we use our understanding that our 60-10 is our longer term trend, and once your longer term trend gets embedded, that means that trend is intact and it's pretty strong. And embedded means you're actually trading underneath in this case, it's oversold embedded. You're underneath the 20 line. Or in this case, we're underneath the 10 line. Now I say if you're looking at an embedded strong stock or a strong market, you want to be above 80. I've recently want that a little bit higher to really confirm that strength. George Lane says it's even better to have it pinned at 100. If you get up to 90, 95, 100, it tends to even go higher. That's a real sign of strength. It's not a sign of being overbought or oversold. It's actually a sign of aggressive, extreme strength. So the same thing happens when you're embedded. You're embedded, it lies flat in that area. The trend is intact. And once you know the trend is intact, and this 60-10 represents the 5-minute time frame, that's a bigger time frame. This is just a little. This 9-3 is nowhere near 63. It's a 9-minute that works to 1 minute. So you have the 5-minute downtrend and you have a 1 minute rotation. So that anytime you have the 5-minute embedded and you have the fast rotation on the 1 minute and it holds under the 20-period moving average, that's what we considered a 2020 bull flag or a 2020 bear flag. In this case, it's a 2020 bear flag. You have the rotation up above 20, up above 80. The slow stochastics are pinned under 20. So in either case, even though you have a divergence there, you got to take it off because you could recognize that this is probably going to be what we call a bear flag. I shouldn't have made it. Let me see. F2. I should do F2. It's not an extended line. Didn't need that extended there. All right, so there's your bear flag. The move down. Flag always comes with a flagpole. The flagpole has to, and there's another concept with this, and again, this is years and years and years and years staring at the screen for 4 o'clock, it's 7 o'clock to 4 o'clock. There's nothing that gets by me. I could see these in my sleep. The important part is your flag has to pull away from the 20. The 20 comes into play a lot here. So when you see that extension from the 20, that pullback back to the 20 is part of that. So the flag has to have that strong move down away from the 20. And then it pulls back to the 20 with a fast rotation back above 80 and a bear flag. If it was a bull flag, it would be that rotation back down under 20. And then the continuation move down in that direction. So we had that. And you're watching this. You see the 20 here, the 20 here, the 20 here. Very strong. Then we had some more news out. And the market continued to sell off. So we got down here. We started chopping around. And at this point, it's a little after 1 o'clock. Lunch is over. Got in here. We had a rising trend here. I took a trade here. I got a 1 3/4 points on this. The reason I'm trying to remember why I took this trade because I'm looking at it here. I took it right on that rotation up here. I think on my other chart I had a different the Medved chart. I'm always comparing my Medved chart and stuff. There was a reason I got in here. I probably had something to do with this pullback and the recovery from that pullback. But I don't see a divergence there, which I normally only take divergences. But I took that one for some other reason. Here we had the market making lows. All right, and this is 2 o'clock at the lows. You know what happens then. All right, so you have your lows come in, and I said watch for a divergence or watch for some type of divergence. And sure enough, right when you got down here, you didn't really take out the lows. But in my, what I call, and again, I add to the divergence process, there's kind of little tricks that you'll find about using this for so long that you sometimes don't have to get exactly down to or underneath it. A double bottom is just as strong as a pure divergence where you're taking out the previous low. But this is what we call a relative divergence. And a relative divergence comes down very close to that price. And normally at that time in the chart, the stochastics were way oversold here. And we kind of got that bounce back up. And then the price started coming back down. And we got real close to tagging those lows again. But we didn't really get real close to getting back oversold. So relatively speaking, the stochastics were relatively stronger, showing relative strength in this pullback. So I call that a relative divergence. And I took that. I said that's a relative. That's right when we started ticking up. I got in, and it moved pretty fast. And I took it off, and I got 2 ticks on it. I think I was kind of nervous because we were right on the lows. I don't like taking trades on the lows because they tend to roll over. So I was taking it as fast as I could. I didn't listen to my rule. If I listened to my rule, I would have taken it off probably another. I got out at 78, and the 20 period movement as 81. I would have left 3 points. I left 3 points on the table basically. I left 3 points on the table because I didn't take it off when we got the rotation. I was a little fast on the trigger there. Because we were trading this off, I like the divergence, but I don't like trading the lows. So I took it off. But this is, again, the situation where you had a divergence, you have your first rotation above 80, and then the market kind of rolled over again. And it would have saved you anyway. Or up against the 50 and the move up is exactly the same spot. So that's important too. The 20 period moving average and the overbought stochastic is always a combination you want to take profits. I don't care if you have 2 ticks or 20 ticks. You know, the big trades will come. Some trades, when you're trading against a trend, you only get a couple ticks. This is what kills traders. They said, "Oh, I need a point. I'm going for 3 points. My bracket's for 3 points." You know, Johnny says he's going to, just giving us enough room. No, I'm not going to tell you that every situation is different. Every market, every day is different because of the news flow and stuff, and the trends. And you have to know that going into it. Like, well, how's the trend going? What's the trend like? Is there selling? If you're selling, why are you buying? Well, if we get a divergence, I'll buy, but I'll be very quick on my exits. So anytime the market is trending down, you have to be quick on your exits, and you have to use your 20 rotation to take the majority of your trade off. 9 times out of 10, it'll work out for you. Here we had another divergence here. And this one was a fast, sneaky divergence again. I love those sneaky divergences where the candle comes down, takes out the lows, but it never really even touched it. The stochastic never turned over at all. And I knew that. I said, oh, look at that. I got in fast, pretty fast. 71, 50, I got 73, almost 2 points. And that's just one candle. Now, didn't really get too far. It never made it up to the 80, but it made it up to close to the 20. And knowing what we know about the markets, this was a judgment call. We're at the lows. We had a 2 o'clock at the lows. It's very dangerous at the lows because you can continue. There's no reason to do that. To continue to bounce. We could just continue to flush out, and that's kind of what we did. So any type of bounce that we have, a divergence, you're in and out real fast. Happen to get a good amount on that. Same thing here. We started to turn back up. We got in. Oh, this one. I remember this one. Remember this one? I said, all right. If you remember watching the show tonight, it was kind of a funny one. I got in there. I said, oh, it's starting to turn back up. I'm a little nervous. It's right on the lows, but I do feel something's going to happen here. And I got in. And I said, well, let's give this. It kind of pulled back, and I said, oh, it's setting up again. I feel like it's going to be a running divergence, meaning that we're going to get a higher low somewhere along here. And we kept on getting it, I said, you know what, I'm going to put my trailing stop underneath. I think we're somewhere here. And I put a couple ticks underneath it. And probably down right around here at 66. And I heard your stop has been hit. So I didn't look at it because it was underneath my Medved chart. And I figured I got stopped out of it. I said, oh, man, I was so mad. I was so mad because it was my first stop out in 2 days. I was like, just in a real good groove. I mean, actually, for the whole week, I didn't take any trades on Monday. I think I've been pretty good all week. There's been no losses. So, needless to say, I'm watching it, and I open up the thing, and I'm still in the trade. It was the Rockbot that got stopped out because the Rockbot was following, had a much tighter stop, and I gave mine a manual stop a little bit lower because I felt it, and I ended up just getting in it, staying in it, and it took off. And by the time I realized what was going on, we were up against the 50, and we got up above that 20 line. I just took it off, or 80 line. I took it off into the 80 line where you should take it off. But I just freaked out and pushed the button at that point anyway. So it just happened to work out perfect. So that was 2.25 points. Another 2.25 points. And then we came in here at 255. And again, you're at the lows and you're coming down. And what happened is we had another relative divergence. Market pulled back very close to the lows here. Very close. but the stochastics turned back. I said, "Oh my God, stochastics are didn't even." Whenever I see this, I get more and more confident on that. So I got in. Said this thing is showing that relative divergence, and it's also showing it on the 14.3, real steep. It looks great. And what we noticed is it was on the 60.10 too. So it was kind of showing up all across the board there, and it actually had a nice little move. And again, I took it off real fast. I got point and a half. Not a lot, but they add up. I think overall I had 17.5 points today. That was at 250. And of course, if you've taken it all, if you got out when it got above the 80, you would probably got out right here on this pop, which will give you 76 instead of 7. You would have got 2 more points. You would have got 2 more points, and if you had a runner on that, you would have gotten a lot more. Needless to say, it would have been a freaking awesome day. In any case, it was, if you just apply those rules, even in a downward trending day. I mean, even a downward trending day when it's just crappy upside, you're getting great signals. I mean, you can't deny. We know why we're getting in them. These are taking extreme concentration now. You have to see that divergence happen. You have to see that divergence happen. That divergence. You have to get out real fast. The 20-period movement has been holding us. If we pull away from the 20 and we have a little divergence, we're going to get a pop to the 20 and we're going to sell off into the 20. I had another trade there. Here was that was 3. That's that one. And then the end of the day coming in. I don't usually trade the end of the day. I didn't trade the end of the day in the market now. But let's go. Let's take a look here. A couple trades that I missed. There was a divergence here, a sell divergence. Oh, please cancel. There was a slight sell divergence here between those two and this right here. And I could see that much better on my Medved chart. That was at 310. That was a pretty good one. You can see it better on the Medved chart. I see a divergence here. This was a real nice one too, and that was a much better one where we talk about the failure to get it back above the 80 line. All right, and that 10-degree angle, and look what happened after that. So there was a couple sell side divergences. There was a bear flag there. We took the long and we sold into the bear flag, but you could have reversed right into a bear flag. You could have ripped this market apart on both sides. We took these trades off of divergences on the buy side. I took a short yesterday. It did well, but I didn't hit any of these other ones. Now the overnight trade, just to kind of finish up this video and just kind of point out some things if we see anything. This is kind of sloppy here overnight. There was a nice divergence here actually. This low and this lower low right there, and it was a much higher low right there. We never got up to that. Never got up to the 20 line, but we kind of got a big pop. Actually would have been fine. I think either way you would have gotten in there pretty good. You would have been in a profitable drone. I don't think you're going to be holding it that long. Market opened back up. 6 o'clock, we started trending back down. All right, we're trending back down. What are we looking for? We have here what's called a 14.3 divergence. If you see a 14.3 divergence and not the 9.3 divergence, that tends to be a stronger divergence, believe it or not. A lot of times you see 9.3 and a 14.3. When you see a 44 divergence, which we don't have on the screen, that is the ultimate. Now, see the low? See the double bottom basically. This candle came in. There's a couple different divergences. There is a 9.3 based off of this candle right there. You see how high the stochastics were at this point right here, and the low was right there. And the previous, just you can't really see. But we're looking at down here at the 14.3, and it's holding above the 20 line on this, and back here it's underneath it. So you can see there's a slight divergence right there. And look at the nice move. And overall, it had a nice move. I don't know if I would have seen the 14.3. Lots of times I'm scaling, I'm looking down. I probably might have missed that. I'm not in front of the computer at night usually. So I'm not going to say I'm going to take all these. But if you, again, my claim is show me a divergence, I'll show you the stock moves in the direction of divergence. Unless there's news or some kind of odd stuff going on. It could be program trades. It could be anything. But usually you get a divergence, you get a little move in the direction of that divergence. You have to be in front of that divergence, understand what makes a divergence. When it comes down to, all you have to do is actually tune in. Get a discounted broker, right? You could use any of the discounted brokers if you want to have low margin. You could use an interactive broker. Ninja Trader is a discounted broker. Apex Trading, Futures Trader is a discounted broker. And then when I say discounted, they give you low margins for the MES. So when you look at trading $50 per contract, you're putting up $150. For 3 contracts per trade. That's nothing. A lot of people start their accounts with a couple $1,000s. You could handle that. You can't really handle it with IB account. They charge like, $2,500, $3,000 for one contract. So it's kind of a big difference. So if you're interested in this type of trading, I'll definitely show you, how you're going to make the money doing it. So you just have to take the first steps. You got to open up an account. Then you have to get with Day Trading Radio. We'll set up your charts right. We'll set up everything. We'll give you the tools you need. We have tools now identifying all these divergences. We have the tools to tell us when the multiple time frames. And I only went over really one setup today, the buy side divergence, and that was for 17 points today. 17 points, 17 and a half points, I believe it was today. Multiply that by how many contracts, and then you pretty much figure out, what you're dealing with. And that wasn't a lot of trading for me. And I took the minimum amount on everything. It was just minimum amount. So, and I didn't even show you the close stochastic setup. I didn't show you the bull and bear flags. I did show you one flag. That was a beautiful setup, but I didn't even trade that flag. And I'm looking back at it, I was like, oh, I should have traded this flag. This was a textbook flag. Textbook. Some sell divergence would have added a lot of points on this. Imagine being in this divergence and catching this nice move. That's probably a 10-point move there. So you could have multiple 100 days. You could double what it's amazing what you could do. But you have to have patience. You have to have the understanding of how divergences work and where you got to get out. You have to have the right tools. You have to work with a team. Like I said, head over to Day Trading Radio. Touch base with me. I'll get you set up. You're going to have to do the legwork and open up your accounts and stuff. But if you need any help finding what broker, wherever you are, you might be somewhere in Canada. You're not sure how to get a broker or how to even set it up and how to set up your charts. I'll help you with that. No problem. A lot of information. So hope you enjoyed this video. Hope to see you in the markets. Let's see, the market's actually almost going positive tonight. Snap came out with earnings last. Oh, what do you see here? All right, so look at me. I'll be up all night trading now. I will be trading in a bit. What do we talk about here? We talk about anytime you got to move up above the 20-period moving average, we consider that a trending market uptrend. So now we are actually any type of pullback on divergences will be much better to leave running. Now, this is kind of a double bottom divergence right there. Didn't mention that. But what do we have here now is a pull away from the 20-period moving average, a pull back to the 20-period, a pull back. What does that look like? That looks like a textbook flag. And how do we measure a flag? Well, first of all, this has to be above 80. The 60-10 has to be above 80, preferably above 85. The higher, the better. In this case, it's at 87 right now. The pullback, we'd like to see the pullback as far back as we can. We'd like to get it all the way back down here close to 20. So we know we get a good bounce off to 20. Sometimes it doesn't get to 20. You might say, well, it's going to chop around and then head lower, and you get kind of scared. So I like to get the original move, a fast move down to the 20. But a strong market won't give you that. A strong market sometimes will push back up. This already started pushing out of the channel, but it does have that, and again, it has to look like a flag. That helps a lot. That aggressive move off of the 20-period moving average, the pull back to the 20, the previous trend is holding above the 20-50 period moving average, it's telling you that things are kind of trending here. So that's what you're looking at there. But there's always opportunities, all right? And those opportunities are every day. So if you want to be a consistent day trader, you got to put the time in, but it can be done. We do it every single day. And if it's something that interests you, get back in touch with me. ironaction@yahoo.com, or head over to DayTraderRadio.com for more information. All right, I think you'll love what you see. All right, this looks like a nice bull flag. I want to send this video out. It's already an hour long. I'm sorry for my long videos. Give me some feedback on this video, please. Give me some motivation here. If you like it, tell me some improvements. A lot of people tell me I'm all over the place. I'm a trader. I'm not a marketer. I really am. I love trading. I don't like to put graphics on here, show my mug, do anything fancy, boast or anything. I think we're blessed to be able to trade, and find something you can do and not be, working for someone else. That's the key. And we've established great relationships and friends between traders. It's just a fantastic thing. So I really hope to see you at Day Trading Radio. There's your bull flag right there. Absolutely, Johnny. Yeah, you just I love it. I love it because I've been doing this so long, and it's so clear now. The setups are so clear because we defined them. The whole playbook, is defined. It's here. Actually, if you head over to Day Trader Radio, if you sign up, if you're not a member, you can sign up for a trial, and it'll send you the playbook. The playbook gets sent to you right away to kind of catch you up to speed. The playbook has it has everything in it. It has this stuff right here. We're going over today. It has all this stuff, all the divergence work, everything, all the rules of how to enter divergence. It's all there. My 1, 2, 3 star divergences, all the indicators you need. This is fantastic. Why am I even giving this stuff away? I gotta get this off the site. All right, I'm out of here. I'll see you guys tomorrow in the market. Again, give me some feedback. Hit the like button. Leave a comment. People tell me I need to do that. Spread it. Forward this if you made it this far. Do something. Pay it forward. Thank you.